It's been hard not to notice over the last 20 or 30 years the total return as it relates to bond investing. One of the issues that we have, or that could possibly come about, many planners, financial planners, use historical data when they're building future financial plans for individuals. For some reason, if you're building a plan that with certain expectations and you're not hitting that benchmark, obviously there's a lot of individuals that could be failing in their personal financial plans. What is the current state of the bond market, and do you think bonds will continue to deliver the robust performance they have in the recent past?
Yes, that's an excellent question. What you have in front of you is a history of the Fed funds rate, the base interest rate in the economy from 1980 to the present. And what you can see is that there has been a relentless reduction in interest rates on bonds. In 1980, 1981, these short-term interest rates were around 20%. The Fed was fighting inflation. We had that peak of inflation following the oil crises and other things at the end of the 70s. And since that time, interest rates have fallen, with some ups and downs, as you can see, fallen relentlessly to where their short-term rates are essentially zero now. What that means, of course, is that people who held bonds, especially longer duration bonds, not only collected a coupon, but they got a capital gain because bond prices move inversely to interest rates. If interest rates fall, then bond prices rise, and if interest rates rise, bond prices fall. So bonds for the last 30 years, on average, given the hiccups, but on average have been an excellent investment because you not only got some coupon, you got some capital gain. In our opinion, this has run its string. This whole thing has run its string. Bonds are not the things that you might expect them to be. Here's our view of what's happening now, and we'll take the 10-year Treasury yield, which is a good base rate for the whole economy. Today, I don't know the rate this morning, but roughly speaking, the 10-year yield has been oscillating around 3.3%. When you think of what determines the interest rate on a bond, there are three components. One is the real yield, which is how much you have to pay to get access to capital, the real return on capital in our economy. The second is the term premium. What does that mean? Well, you could buy a Treasury bill which matures in 30 days or 90 days, or you could buy a 10-year bond or a 30-year bond. Normally, people want to be compensated for locking up their money for longer periods of time. Anything could happen. You might need the liquidity and so on. So the increase in rates just because the lockup is longer is called the term premium. And finally, there's inflation expectations. If you thought there was going to be inflation, then the purchasing power of your money when you get it back is less than when you put it in, so you need some compensation for that. So if you look at the picture on the left, which is our view of the current situation, we think inflation expectations, this is based on survey evidence and evidence from the TIPS market, is around 1.5%. The term premium is remarkably low at around 0.5%, and the real return on capital, 1.3%. Inflation expectations and the real return on capital are low because the economy is flat on its back. We've had that discussion. What is the real return on capital in the middle of a recession? It's not very much. And how much inflation can there be when so many people are unemployed? There's no wage pressure or anything. So inflation expectations are low, real yields are low. And the term premium, why is that so low? Well, it's because people are desperate for yield. Imagine you're retired, you're living on the coupons, and the coupons are 1%. You're saying, I can't deal with that. I've got to have more income. And then someone says, here's a 20-year bond with a 3% coupon. You buy the 20-year bond, even though 3% is a ridiculously low coupon. So in effect, people are asking very little to lock up their money for long periods of time. On the right is what we think will happen in as little as 2 years. We think that inflation expectations will go from 1.5% to 3%. You can see the beginnings of that now. My wife always jokes with me. She says, gosh, I'm so happy that the Fed says there's no inflation. It's bad enough with the price of everything I buy going up. Right? And you all know that. If you've visited the supermarket, you know that inflation is not what the government says it is. Well, eventually everybody's going to wake up to that. We think inflation expectations are going to roughly double from 1.5% to 3%. In terms of real yield, that's going to go up too. The economy is recovering. Pockets aren't, but pockets are. And as the economy recovers, there's going to be a demand for capital, for investment. People are going to build things and factories are going to be set up and so on. So the real return on capital will rise and the real cost of capital will rise. And the term premium is going to rise because once interest rates go up, as I said, bond values will go down and everyone's going to say, whoa, wait a minute. If I hold this long-term bond and interest rates go up, I lose money, I need compensation. If you put this together, what we're saying is that roughly speaking, within 24 months, we expect the 10-year Treasury yield to have risen from around 3.3% to around 6%, nearly doubled. When you reflect on the fact that companies, even highly rated companies, pay between 100 and 200 basis points above what the Treasury pays to borrow, we are talking about interest rates on good quality bonds in the 7 to 8% range. So we expect that there will be a really big pickup in return. And you might say, well, Russell might say, well, that means bonds are good. Well, yes, if you start with cash and buy them then, they're good. If you hold a 20-year bond today, this picture that I've given you is a disaster. Let's take something straightforward. Let's take a 30-year Treasury bond. There's no credit risk on that at all because the Treasury really will pay back in dollars. Roughly speaking, the so-called duration of a 30-year bond is 20. Now, the duration of a bond is not its maturity date. It's a more complicated calculation, but what it means is this. If the duration of your bond is 20, if the interest rate goes up 1%, your bond loses 20% in face value. This is a dramatic thing. You've already seen that. If you've been holding bonds, the last 8 weeks have given you very significant losses, and the bigger the duration of the bond, loosely related to its maturity, not quite, the more those losses are. So our investment policy has been consistently for the last 12 months to keep our bond durations very short. This has meant that the interest yield has been low, but it has also meant that our clients have not taken anything like the losses that bondholders have taken in the last 2 months. So this is what's going to happen to bond yields, in our opinion.
And if this change in interest rate environment does take place, as we expect it will, this would obviously give our clients dry powder to reinvest at higher yields.
Oh, absolutely, yes. I mean, we're very bullish on investing money, but right now we're at a turning point in the economy, and this is a time when you should not be buying long-duration bonds. It is extraordinarily risky to do that.
It's hard to have an economic discussion without talking about the buzz asset classes that are quite frequently discussed. And what I mean by that, talking about emerging markets and commodities. One of the fears that I always have as an advisor when I'm talking to people is, as this is commonly talked about, people become more comfortable with as an investment. They seem to think that, well, it always goes up. There's high expectations of returns and minimal risk. Sounds like something we know very well. Will you talk a little bit about the emerging markets and the commodities market and some of the concerns you would have, if any, in investing in that market?
Sure. So I think what we're talking about is delusions, enthusiasm, belief in money for nothing. We used to believe that real estate always goes up. I know no one listening to this webinar believed that, but other people in our country believe that. And indeed, I've got here on this picture a commercial real estate index, and you can see between December 2000 and roughly the middle of 2007, an index of commercial real estate went up 85%. This was what always went up, and everyone kept buying it and leveraging it up. You can see that all of that was given back. So the real estate delusion, I think, is over, at least for the next year or two, in our country. This has been replaced, as Russell said very correctly, by the belief that, oh, well, real estate doesn't work, but there are these other things that do. And these other things are, as you said, emerging markets, commodities, gold. Gold is a real winner here. And I refer to this as faith-based investing in homage to our former president, who believed in many kinds of faith-based initiatives. And if you look at what has happened, emerging markets are indeed growing. I said that earlier, and this is all true. But the fundamental thing about buying an investment asset, which is true regardless of whether it's in China or in Reno, is that there is a price that makes it cheap and a price that makes it expensive. So beyond growth, you have to look at valuation. A supermarket is a supermarket. If it's in Beijing, it's still a supermarket. It has very low margins, and it has a certain amount of profit, and it has certain growth potential, and you can figure out how much you would pay for that growth. Whether, as I say, whether it's a Chinese supermarket or it's Kroger or Safeway, whatever it is, it's a business, it has a value, and you can overpay or underpay. You look at the chart we have here, this looks at investor flows into emerging market equity funds and bond funds. And you can see that as our economy looked lousy, people discovered China. They discovered India, and they poured money into it. They poured money into bond funds, and they poured money into equity funds. The picture on the right is one measure of the valuation of emerging market equities. It's not worth going into the technicalities of it. If you want to talk to us, call us up. But roughly speaking, the red area on the left says emerging markets seemed cheap up to about 2006, And now, thanks to that explosion of enthusiasm, we believe that these markets, again, depends on how you look at it, are somewhere between 10 and 20% overvalued. That's not to say there won't be economic growth, but that does mean that you won't get a return from it, because even if it grows, you'll have already bought that growth and the growth yet to come. There's a wonderful book about the Great Depression, actually written by an economist called John Kenneth Galbraith, who, reflecting on the bubble of the 1920s, at one point said that the valuations discounted not only the future but the hereafter. And that's unfortunately what is happening in some of these markets today. We are bullish on these markets, but we are watching valuations. There will be a correction in these markets. There's the inflation and all the problems I said. If the chart on the right goes back into the red zone, we'll be buying. Right now, you have to be very, very careful, because everyone's enthusiasm for anything, just like it did for real estate, can cause perfectly good office buildings, perfectly good things to be priced too high.
So it sounds like there is a place for emerging markets in a portfolio, but you would call yourself not overweight and underweighting, but neutral. Is that a good term to use?
Well, we are moving to the downside right now. We are waiting for the correction. So yes, these valuations are very loose concepts. We don't hold nothing, but there was a time when we were much more enthusiastic than we are today, and I think the essence of dealing with the market that we're in, and we'll come back to that later, is that you have to move. You can't be a passive investor, just buy and hold and sit. And this is typical of why you have to move. There are times, 2005, when it would have been great to buy, and there are times today perhaps you shouldn't hold as much, and those times to buy will come again. And you have to move this portfolio very actively. We can talk about gold and commodities if you want.
Certainly, absolutely.
Gold, everybody loves gold, and it's not just that people are losing faith in the US dollar. As you can see, gold priced in any currency has been going up. Gold in dollars, gold in euro, gold in yen. So everybody loves gold. And this is true not only of gold, but of other commodities, as I said, copper, iron ore, agricultural commodities, you name it, all of them have been going up. And this is grand, and we believe it, but this picture shows you something very interesting. I've helpfully taken it back to 1800 for the older amongst us. And what you can see, this picture shows you the deviation of raw material prices from their trend. This isn't the level of prices, this is what's happening on average and what happens over cycles. What you can see is that raw materials go through bubbles, and they have gone through bubbles not just for the last 20 years but for the last 200 years, and you can see that we are on the upside of one of these cyclical bubbles. So are we bullish about commodities? Yes, we are, but are we ready for the cycle to turn? It won't right away. You can see it's quite jagged. There'll be ups and downs. If China slows down, there'll be a down, and then it'll go up. But remember, when you invest in commodities, agricultural land, all of this stuff, you are not investing in something that's going to go up for sure. You're investing in something that's highly cyclical. And one more point about commodities. This is deviation from trend. The trend of all raw material prices is not up but down. In real terms, adjusted for inflation, every raw material is half, with the exception of oil, is half roughly the value it had 100 years ago. Our society is much more efficient at using energy and other raw materials. Our society is much more efficient at producing them. And so we're better and better at doing this. On average, raw material prices fall every year, but they have these huge cyclical bubbles which disguise this fact. So we're bullish, but we won't be bullish forever. And let me make a final comment, because I've mentioned this a number of times. These waves of enthusiasm, the borrowing, the leveraging, all of this is a national pastime. Lately, we have had a lot of political commentary on the excesses of government. We've got the Tea Party and all of this. What this picture in front of you shows you is the reality as opposed to the political rhetoric. This is the surplus or deficit of the U.S. federal government only. It's not states and municipalities, just the federal government as a percentage of GDP going back to the end of the Second World War, going back to 1950. What you can see is that from about 1960 onwards, the government has essentially run a deficit always. regardless of whether the Republicans were in office, regardless of whether the Democrats were in office. Indeed, the only significant surplus since 1960 was in Clinton's presidency, which was the presidency of a Democrat, which doesn't sit very well with the current political rhetoric. But in any event, what you can see is that this is not a party issue.